Welcome back to Market on Close. I'm Renita Young in for Oliver Rennick. And it's time now to welcome in Mr. Schultze. We're talking with George Schultze. He is the founder of Schultze Asset Management. And we're going to talk about first the Fed. Why not, right? Thank you for joining us. But let's start with your thoughts about Powell's testimony, or ahead of his testimony this week. Kevin Hinks tells me it depends on which Jerome Powell we're actually going to get tomorrow.
I think that's right. Yeah. So in January, the Fed raised rates by another 25 basis points, and we're hearing a lot of tough talk coming from his camp. But really, if the Fed was serious about raising rates, they should probably be at 8% or more if they were serious about, really shocking the system and stopping inflation. And these little baby steps, they don't really amount to that restrictive monetary policy. And in fact, you're seeing an offset from the opposite side, from fiscal policy, which continues to be very expansionary. There's massive deficit spending, and because of that, we're likely to continue seeing lots of inflation going forward. And right now, because of that, you have pretty much modest GDP growth, record low unemployment, and this expansionary fiscal policy that continues to make investors optimistic.
With all of this competing data, is it time for a real shock to the system? And what does that look like?
Yeah, so, again, if the Fed was really aggressive and interested in, stopping inflation, and the target is 2%, but we're way above that right now, the question is really, why shouldn't we be at zero in terms of inflation? But to really shock the system, you'd have to go way up beyond what most people expect this year, which is 5 to 5.5%, maybe as high as 8 or even higher above that. There's no reason, really to maintain it at such a low level. So you're really not shocking the system yet with monetary policy. And because of that, here at Schultze Asset Management, we expect that you'll continue to see inflationary trends.
All right. Well, you've got a few long positions in the market right now. Let's start with AMI.
Sure. That might be a typo. AMR, which is Alpha Metallurgical Coal, which is a pure play met coal producer that operates in the U.S. Met coal is used for steel making, and it has a great balance sheet. But even despite that, it trades at just 1.2 times EBITDA, and we think it will benefit from this continuing inflationary trend.
You're absolutely right. It was AMR. I misread that. But you're also looking at Vistra Energy.
Yeah, that one's interesting too. In fact, they had a very interesting announcement this morning. The stock's up 14% today. It's a major utility that has both retail and electric generation, and it also has ESG-friendly distribution and generation that it's building up, and that's part of the announcement from this morning. But this company, Vistra, has a huge stock buyback program. Last year, they reduced their stock float outstanding by 20%, and they announced another $1 billion stock repurchase just today.
Wow.
So despite that, it trades at about half its multiple of its peers.
That's huge. And I want to ask for a couple more. Bed Bath & Beyond is really on a lot of folks' minds now, especially with just all the activist investor pressure, as well as this company trying to find a way to continue to operate, right? What are you looking at on Bed Bath & Beyond since you're short on it?
Yeah, just a couple of weeks ago, this one was looking at bankruptcy, and they really pulled the rabbit out of the hat. They raised $225 million through a very dilutive convertible preferred stock offering. However, what people aren't really focused on, perhaps, is that the stock will be diluted by approximately 80% if that convertible and the warrants that were attached to that asset raising are fully exercised. And so the true price per share for that raise was about 76 cents a share, versus it's still trading at about $1.45. Now, importantly, for Bed Bath & Beyond, also, its debt that's senior to the stock is trading at about 13 cents on the dollar. And really, this is an old line brick and mortar retailer that has lost the secular change battle. And at its current multiple of about 17 times EBITDA, it's completely overvalued.
Completely overvalued. That's what I've heard a lot of other analysts say as well. And so last time you were here, you were looking at GM. And what are your thoughts on it now? Have they changed?
So GM reported pretty solid earnings over the last couple of weeks. the outlook for automobiles is, of course, challenging, particularly if we face a recession later this year or into 2024. But the interesting thing with GM is all the new electric vehicles that they're launching. And I think that's an exciting story. Not only do they have electric vehicles, but they also have their Cruise automotive division, which is fully autonomous automobile driving. And those two drivers of growth for the business should help offset the risk of cyclical recession risk for any automaker.
Enough to offset the risk, but is it enough to make them a viable competitor for Tesla, for instance?
I think for sure. GM has spent a lot of money. It has a great balance sheet. It's building plants in the U.S. I would say it's, they're probably the number two in terms of, the businesses that will get market share in the near term from EVs, with Tesla having really, the initial market share, but GM having a much longer history, big cash flows to support its growth, and, just outstanding brands.
Last minute, we have also looking at cannabis operator Clever Leaves. You were looking at that not too long ago. What are your thoughts right now?
Yeah, so this company's going through a bit of a transition. They clearly need to grow their top line revenue, and they'll be reporting in just a couple of days. So we'll be watching that closely.
All right. George Schultze, thank you so much for joining, founder of Schultze Asset Management.